Very much, Alan. Right, in a moment, I'll just throw the floor open to any questions. I just had a few comments of my own at the end of these presentations and comments on the basis of my own work, particularly in Africa. Firstly, I think the study is extremely useful in hammering home one point which has been one of the things which struck me very often in travelling abroad, that competition policy is a much broader concept than competition law. Normally what I'm taken out to Africa to do is to write competition law. That actually will deal with things like cartels, abuse of dominance, it'll deal with control of mergers. They are necessary ingredients for what a competition authority does in relation to markets which are open to competition. But it's not normally the function of a competition law as such to take on the task of making those openings. That's a matter for government to investigate its own other policies, its broader concerns, and to decide how much it wants to have to introduce competition into sectors where law and practice had hitherto prevented it. Secondly, I think it's extremely important that the competition authority, besides having this specific function in relation to the law, does also play the advocacy function. I can only endorse exactly what my colleagues have said this morning about the importance of that function. And I think what Mr. Sampert told you in his presentation really is crucial to this. There he sits in a competition authority able to intervene with government whenever the government is taking new initiatives or pointing out activities of government which are anti-competitive in their effects. That is a major function for a competition authority to perform. But as you'll also see, it does take a rather special sort of person to be able to do that. Members of a competition authority are normally appointed by the government. And I think, as Mr. Sambay himself hinted, there are therefore some limits to which they can actually put themselves out on a collision course with government in pointing out ways in which the government are getting things wrong. And whereas I've gone around Africa stressing the importance of having independent competition authorities, and I'm sure that is right, there is nonetheless a dilemma here, which is very, very difficult sometimes to overcome. Certainly at the personal level, the calibre of person you need in a competition authority, person of high personal reputation, of high personal integrity, and obviously with the presence to make those observations felt in government, is actually quite a rare commodity. It isn't only the competition authority who wants him, it's umpteen other people who want him for the same thing. There is a scarcity of resource of that quality. And therefore to find the right people is a bit of a struggle, although it can be done. And I think Mr. Sampa showed that has worked in Zambia. Another point I'd just like to mention is that one thing has not been mentioned today, which is actually quite significant, particularly in Africa, is the arrival of the Chinese. The Chinese are a very significant force in investment in Africa. They are precisely in the category of those mentioned by Mr. Samba who are regarded as desirable FDI by governments. Governments are not anxious normally to look too closely into the activities of the Chinese, who are bringing substantial infrastructure investment and indeed very beneficial infrastructure development to parts of the country. But nonetheless, the Chinese are not natural participants in the sort of commercial world we would always recognise. They have their own agenda, and they are a major force in Africa and one to be reckoned with. And certainly, while in parts of Africa they are undoubtedly there for the long term, investing in copper in Zambia and other resource utilities of that sort, in a place like Lesotho, where they have a very highly developed textile presence in the textile industry, they will be gone tomorrow if the regime changes in America and they can no longer get their textiles into the US on preferential terms. So there are two aspects to that presence. But I think for those of you who are scholars in the developmental world, it's worth bearing the Chinese dimension very firmly in mind, because it is a major factor now in Africa. I mentioned also the views of the consumers have been referred to today, and obviously they are crucially important. The consumers are, after all, one of the real beneficiaries of an effective competition policy and an effective competition law. And the point I think to get home to business is that business is also a consumer. It's a consumer of business services. Particularly the small and medium-sized businesses are utterly beneficiaries of a system which makes the inputs to their businesses more efficient, more competitive. Once that thesis gets home, when you talk to the chambers of commerce and things, they begin to become a little more receptive to the idea of competition law and policy. They do not want a competition law which they would perhaps fear would be a minute regulator of day-to-day pricing and that sort of thing. That's what they fear. When they come to realise that actually it's a means of enabling them to obtain their own inputs to their process in a rather more competitive way, they can actually be won round to become quite supportive. I think on COMESA, mention was made of COMESA and SADC and the international dimension. I mean, utterly agree with Alan's comments about the difficulty of having an agreement which transcends national sovereignty in the context of, such as Africa or other parts of the world. It is a major challenge. It may work, but we have to look at the European example. The Treaty of Rome was signed in 1957. I think for the first 20 years of that, there was virtually no competition activity at all in relation to the Treaty of Rome in Europe. So it's an evolutionary process. And what the role of the competition authority needs to be in the initial years is very often to be a gadfly, to be a critic, to be someone who's actually pointing out inadequacies. And that is as important a role as it were as the minute direct administrative task in regulating, which is something which will grow with time. Maybe in the end the African Union will develop to the point where it can actually have more regional organisations capable of acting directly, but I think it's a time away yet. The solution adopted in SADC was not to go for a single supranational authority, but to have a regime of collaboration between authorities, under which they agreed to share information, and under which one country will agree to investigate on behalf of another country if a practice is occurring in its territory which the other country feels is damaging to it. I think that's actually a very good way to start, and I hope it will be built into something worthwhile. Certainly on the consumer side, I would also mention there's a very definite complementarity between consumer protection and competition law. As markets are liberalised, they are often ill-informed consumers in some of these countries, are subject to a range of choice which they never had before. They're also subject to a range of junk brought in through the trade liberalisation route, which means that substandard items are all too easily sold on the market, and the consumer is all too easily misled as to the worth of these articles. There is a need, therefore, for an effective consumer protection policy to complement liberalisation through competition and trade liberalisation. It is being done in a number of African countries, and it will, of course, be another means of actually building up the consumer voice to the point when it can be used as a counterweight to the power of business. And finally, I think I do very much agree with Karen's comments on industrial policy. I mean, obviously, the industrial policies pursued by some countries in the days, I think it is either Zambia or Ghana, I can't remember, which had the same GDP as South Korea, I think in the 1950s. Now, South Korea has somewhat developed since then, rather faster than those two countries, and it's developed, of course, behind massive tariff barriers, protecting its own industry, behind policies which were anything but market liberalisation in the classic sense we have today. But they were highly successful. They were highly successful policies, and obviously people see that, and they ask the same question: do we need that degree of infant industry protection? And in some respects, I think there will be cases in which an enlightened policy of infant industry protection will be quite efficient, certainly perhaps within the context of a broader regional market and not necessarily just within the national market. I don't think one should turn one's back too sternly on efforts to actually introduce benign infant industry protection. And I have to agree with Alan's last point that there are some things which can be done by the state better than other activities, as long as the state is prepared to be open to ideas as to how they can be done efficiently. It is intriguing to me that in the Vietnamese cases cited by Karen, these are state enterprises very often which are entering the regime of competition and doing so quite effectively and efficiently. There is no necessary correlation between state activity and total inefficiency. I'm afraid that correlation does occur more often than not in Africa, but it obviously is not occurring in Vietnam, which is an interesting observation. But even in Africa, there will be things, I think, which the state ought to be prepared to go on doing, and doing to the best of its ability, because I don't think there's any other way in which it can be done for the benefit of the citizenry as a whole. Those are my observations on arising out of today's presentations. Now we have some time left for questions. Would anyone like to put questions to the panel? To me, please. Would you say who you are when you ask the question? The microphone is coming.
Thank you, Sheila Page, ODI. I really wanted to pursue the international dimension a little more, because certainly in some of the sectors and countries I know, the companies you're talking about are foreign-owned. They are certainly sugar in the African countries, cement, brewing above all, and that must influence both the attitude of the government and their attitude towards competition authorities in one direction or the other. And I'm surprised you didn't include a column for foreign ownership in there. Secondly, you cited the example of Zambian sugar being competitive on foreign markets but not on the home market. that may not be two separate observations. I mean, one of the ways in which they've always had an assured high price from the foreign market. Maybe they now feel they need an assured high price from the domestic market to replace that. So the competitiveness may not be all that competitive. And thirdly, and this comes into Alan's point about free trade, the international market for sugar, for cement, is not all that free. So allowing imports may not, in fact, allow cheap imports because the sugar in Zambia's neighbors is produced by the same company. So there's undoubtedly a lot of market sharing happening. How does the competition authority deal with that, where there is really a completely uncompetitive, not just uncompetitive firms, which an ideal regional authority would deal with, but the whole structure of the world market in, at the very least, sugar, cement, and telecoms of your three is run by a relatively small number of companies.
Yes, should we take one or two questions together first, then we'll answer them together.
Joe Hanlon from the Open University. 2 quick points. One is vitamin A. Vitamin A was the donor's magic bullet a decade ago. I'm sure Zambia got all sorts of praise for introducing vitamin A in sugar. So we shouldn't forget that it's there for a health reason, not for a trade policy reason, and it's there because we promoted it. Zambia wouldn't have done it itself. The second thing is I tend to work in Mozambique, which has very different issues. It has no competition authority. It has no industry policy. And the reason is that the donor community, led by DFID, has always said that monopoly profits are necessary to encourage foreign investment, and that the priority for Mozambique is to encourage foreign investment. So, for instance, there used to be 3 competing breweries, all state-owned, but producing wonderful beer competing. They're now all owned by South African breweries. The 3 competing cement companies are now owned by a Portuguese company. They no longer use domestic clinker, et cetera, et cetera. And this was the cartel, the sugar cartel, of course. All of this was encouraged by the international community on the grounds that any kind of competition restriction would discourage foreign investment. Now, I think one needs to think about if your interest is investment from large transnational corporations, should the international community be promoting this? I mean, competition, arguing for competition here is in a sense taking it out of the context of other donor policies, foreign investment, health, other things which have been going on at the same time.
Thanks. Do you want to have a go at that, Karen?
Yeah.
Okay.
Yeah, I mean, I think this point about the international market, which you both raised, is a very good one, and I think there's also possibly evidence, I haven't looked at this in much depth, that is getting stronger. So there's more consolidation within certain markets internationally, so that you're getting fewer and fewer multinationals competing with each other. And that may have significant implications for how this works globally. I suppose the question is whether, maybe in some ways that they are better competitors to each other than if there were smaller players. I don't know, but it's definitely an issue. Maybe less in mobiles, I think, but certainly in cement and sugar, that's definitely the case. And it's very difficult. I mean, to be honest, we talk about regional competition authorities. I'm not sure they're ever going to really be able to tackle this effectively. They're hugely powerful companies, and they hold so much sway. They are very influential with governments who want to attract them desperately. So whether they let a regional competition authority override those kinds of considerations, I think is very questionable. So. At a recent conference I was at, there was a big debate about whether we should be changing the way we run competition law, even in the EU and the US, to tackle this problem, because we're allowing greater sort of consolidation within certain sectors of multinationals, and that is a problem that we may not be able to tackle if we let it continue for much longer. So I think that's a huge debate that's going on at the moment, and certainly a very good question. If we can't control it, then some of the smaller sort of low-income countries definitely aren't going to be able to control it. On vitamin A, I think Zambia is the only country now that has that though. So I mean, everyone else has got rid of it. So although you may be right, I don't know the history of it, that that was promoted by donors, etc. They still continue to pursue it despite the evidence that that's not in their interests, and every other country pretty much has got rid of it. So it seems that they're using that, and many people within Zambia believe that they're using it specifically for that purpose.
Can I make a quick?
Please.
Just on the point you mentioned about monopoly profits needed to attract FDI, I think a lot of the time the more important factor is the market size that a company is going to get when it gets to that country, either by using that country as a basis for export or in the domestic market. And yes, if there is a lack of competition, then that helps you, than if there is. So that is a truth somewhat. But there are possibly policy levers around this. For example, providing some kind of protection for imports for a specified period of time while a company sets up, but then withdrawing it. Or there are other levers, but the best solution is still to have a competitive market. But if you can't, are there kind of time-limited kind of protection that you can offer to still attract FDI? I don't know. These are just things that perhaps could work around that. On the case of vitamin A, in terms of its health benefit, I'm not sure, but definitely, anecdotally, there was a lot of talk about that being purely an agreement between government and the private entity, in this case, to institute it as a form of protectionism. So there are probably other ways of getting vitamin A to the population rather than through sugar as well. So I think that's...
Yes, I think on the example you quoted of Mozambique and the breweries, I think there is just a genuine dilemma. Is Mozambique ever going to be a significant enough market to sustain something other than a branch, if you like, of a major brewing company? I don't know the answer to that, but I suspect the answer is that the demand base in Mozambique is so scattered geographically that it's always going to be difficult for them to compete against South African products, whether they're actually produced locally under license or whether they're actually trucked in by truck from South Africa. I mean, there is, I suspect, ultimately just a question of critical mass. But I'm personally quite sympathetic to the idea that certain industries which have a chance of survival should actually be given some degree of short-term financial protection to enable them to establish themselves. And I think there will be cases where this will be successful. But I'm afraid if they are unable to succeed within some finite period over the protected as they would be on a short-term basis, then I think the question must be asked, well, are they the right way of using scarce national resources for the purpose of producing a certain factor of production when it could be done more effectively by other means? And if this is done more at the regional level, at the COMESA or SADC level in Africa or the other levels in Asia, then you have the means of producing a sufficiently large mass, I suspect, on a regional basis of potential market to serve, which can still enjoy a degree of external protection against the outer world and enable the more effective allocation of resources within the regional grouping. It's a challenge, but it may work. But what I don't think is going to work is actually permanent protection for industries within the context of such countries, with no ability to actually have the stimulus of competition to keep them on an efficient basis of production. That, I fear, ultimately is the path to loss. And there must be things which an effective foreign investor in Mozambique, for instance, will be able to do better in Mozambique than he can do in a number of other countries. And the key is to find those things and make sure they are done effectively and profitably.
No, but it was the opposite way around. The attempt to stop South African breweries from having a monopoly was stopped by the international community as saying this was a restraint on foreign investment. Okay, I'm with you. Yeah, no, I agree. It seems. I think the movement has definitely moved away from that. I think now. Now we have a question here is asking us what private sector institutions, perhaps financial institutions, can influence their relative level of competition and how. Do you want to have a go at that, Karen, or?
Yeah, well, I think probably the previous response addressed that partly. I think private sector players do have an impact on competition through the anti-competitive practices that we've been talking about, and to the extent we have fewer multinationals in certain sectors, they are going to have a big impact on competition in the market. I think the specific sector that springs to mind in response to that question is the financial sector. I think the extent to which the banking sector supports certain businesses. Maybe it's, you know, particularly willing to support big businesses. Certainly in the context of Vietnam, where they know that certain businesses have the backing of government, they're much more willing to fund them and not the smaller enterprises. Then that can have an impact on competition as well. So that's an example where the private sector institutions can have a big impact.
But in the banking sector, you'll normally need the support of the central bank to issue the regulations which enable the smaller banks and the credit institutions to operate perhaps to rather less stringent standards than the major banks have to. That certainly has worked in some of the countries I've been in. There have been deliberate efforts to make sure that these small-scale credit institutions can actually operate rather more without having to go through the whole paraphernalia of banking regulation which applies to the big boys. In that sense, of course, you'll get very often the opposition of the big boys to what's going on. But I think it nonetheless is a demonstration that small-scale enterprise, even in the financial sector, can still actually produce results in getting financing out to those who actually are capable of benefiting from it.
I think we have to stop at 2:30.
I think, and we said we'd stop at 2:30. We're slightly over, so unless there are any others dying to comment, we'll bring it to a halt there. Can I thank you all for coming? May I add my own thanks to the authors of the report, which I think was an extremely valuable addition to the literature on this subject. It is a fascinating subject. I hope you'll go on taking an interest in it. I hope you'll leave today less confused than when you arrived, or at least if you leave confused, you're confused in a more informed way than you were when you arrived. Thank you very much indeed for coming. Thank you.